Hello traders, in the zone here with another video. Today I'm going to talk about how I trade the opening range. Now every time I've attempted to do this video it has turned out really long, and I don't want to create long videos because nobody wants to sit and watch a long video, but there's so much information in the opening range method that I use that it's very hard for me to do a short video on it. And so what I've decided to do is just do like a highlight, okay? Just hit the major points, and hopefully it'll come out a lot shorter. It'll be a lot better. I really need like a webinar to really do it justice, and I just don't have that time frame here. So let's get into it, okay? For those of you who don't know, I trade a version of Mark Fisher's ACD method. Mark Fisher wrote the book The Logical Trader. And in this book is a wonderful book. If you haven't read this book, I highly recommend that you go out and you get a copy of this book and you read it from cover to cover, because it is a wealth of information, and it really should be read. Okay, so the ACD method all begins with the opening range, and of course, what is the opening range? And some people, I know pit traders, a lot of them use a 1-minute opening range, and some people use a 15-minute or a 30-minute opening range, and it's basically the opening range is just the initial time period, okay? And Fisher would use, he would say you need to match your opening range size to the type of trader that you are, okay? So if you're a scalper, you'd want to use a smaller opening range, as if you're a swing trader, you'd want to use a larger opening range. It took me lots of years to figure out exactly what opening range to use, and so I have settled on a 10-minute opening range. And so what I do is I use a 10-minute bar chart, okay, and I simply mark the high and the low of the first bar of the day. Now I'm in New York time, so I'm going to start the day at 9:30, the pit session, okay? So I just mark the high and the low of the first bar. Makes things very simple for me. Just put a line on them, and I immediately have the opening range. And so once you have the opening range, it's like, okay, what do you do with it? Well, in Fisher's book, he talks about how to define a breakout of the opening range, and whether or not it's a true breakout or if it's a false breakout, and whether you should take the breakout or not. And so what he came up with is A points, okay? Now, I like to call them stretches, okay? Like an upper stretch and a lower stretch. These points are, if price leaves the opening range and can stretch to a certain point, then it's either going to get rejected at that point or it's going to get accepted at that point. And then if it gets accepted, then it's going to continue the breakout, and that breakout would be, a good breakout to take and take trades in that direction. So I like to call them stretch points, okay? I think it's an easier understanding. Fisher called these points A points, okay? So how do you know where these points are? Well, Fisher, in his book, kept that information proprietary, okay? He kept it to himself, and I know he took some flack for it, because if you read the whole book but you don't have this calculation, it's virtually impossible to trade the method, okay? I found enough value in it that I decided that, hey, I need to figure out what he's using for this calculation. And the problem came when you're using different size opening ranges. You're trying to figure out what's the proper size opening range, which is going to change where that A point is. And so it was a long process for me to come up with what I'm confident that I have now. Okay, so I came up with the stretch calculation that I feel like is spot on. Okay, and I don't know if I have exactly what Fisher use, but I'm pretty sure I'm pretty close to it. Okay, and so the way that I came up with the calculation is simply stated, the stretch is calculated by taking the average daily range. Okay, this is ADR, not ATR. ATR takes in consideration gaps. Okay, ADR simply takes the bar, the daily bar, and measures the high minus the low. Okay, and so you measure that range. Okay, that would be called the range of the day. And so it's basically the high minus the low over the past 30 days, and then you take that and you multiply it by 20%. Okay? And so let's go over an example here. Let's say that over the past 30 days, the ADR is averaging 18.25. Okay? So we then take that 18.25 and we would multiply it by 0.20 or 20%. Okay? And by doing that, then we come up with a number, 3.65. Okay? This is the number that we're going to apply to the opening range. Okay? But we're going to apply it, you know, to the high and to the low of the opening range. Okay? And I'll get into that in just a second. So doing this math every day, you know, gets to be a little bit laborious. So I created on TradeStation a indicator that calculates the ADR, and then it also multiplies it by 20%, and it spits out the number for me. So every day at the end of the day, I can just look over at my chart and see what the number is. And I've provided this code here for you, and you can, if you have TradeStation, you can simply just copy and paste it right into an indicator and create your own. If you don't have TradeStation but you know how to code, you could take this and put it into the language that your platform uses and have the code. But anyway, this is how I came up with the stretch calculation. Okay, and so what do we do with this calculation? Okay, well, we add it to and we subtract it from the opening range, but we do it from the high and from the low. Okay, so we're going to take that 3.65 and we're going to add it to the high of the opening range high, whatever that number is. We're going to add on 3.65 points. Okay, that's going to give us our upper stretch or our A point. Okay, so this would be our A up point. Okay, then we're going to take that same 3.65 and we're going to minus it, okay, from the opening range low, and we're going to come up with our lower stretch or our A down point. Okay, so this is our A down point and our A up point, and then what we have to do is we have to wait for price to make a move outside of the opening range. Okay, so let's see how this is supposed to work, okay, in an ideal situation. We have our opening range, we have our stretch points, okay? Let's say price moves out of the opening range and moves above the opening range high, and it starts to push towards the upper stretch. When it gets to the upper stretch, Fisher said that he has a time and price filter, okay? The price, of course, is the stretch point, okay? The time filter means that price needs to stay at that point for at least half the time of the opening range size. So we've got a 10-minute opening range. We need for price to stay at the upper stretch point for at least 5 minutes in order to confirm the A up, okay, what he called an A up. And so if price moves up to that upper stretch or that A point and it can't spend time there, then it's getting rejected and it's not being confirmed. What you want to see is you want to see price move up to that point and be able to maintain that price level for at least 5 minutes to confirm the A up. Okay, and so that would be a successful breakout of the opening range if it can reach the upper stretch and stay there, not get rejected. Okay, And so, like I said, he would call this an A point, or the A up. And he would say in the book, this is you now have either a long position or a long bias. Okay? If you are getting long here, then of course you need to know, where do you get out if you're wrong? Well, that comes to the B point. Okay? And where do you place your stop? Well, Fisher placed his stop at the bottom of the opening range, and he called this the B point. All right? So if he established a long at the A point, he placed his stop at the B point, and I found that this stop was an awful big stop. And when you're trading a smaller account, it's hard to have such a big stop. And what I found was that on average, now, of course, volatility changes with the market, but from day to day and from month to month, volatility changes. But on average, the opening range is anywhere from 4 to 5 points, so about 4.5 points opening range size. And then, like the illustration that we used with a 3-point A point, a stretch point, you're looking at 7 points there. Well, if you established a trade at the A point and you've got to use a 7-point stop, that's a big stop. Now, if you've got a huge account and you're trading millions of dollars and you can, afford to use such a big stop, then that's fine. But when you're trading a smaller account, I need a smaller stop. And so what I did was I studied this for a long, long time, and I watched, and I would say, okay, if they confirmed the A up and it went on to be a good A, and prices continued to move in the direction of the breakout, I found that prices should not close back into the opening range. And so what I did was I moved my stop to a closing bar back into the opening range. And when I say back into, what I mean is if it were to close below the high of the opening range. Okay, so I found that if it confirmed an A up, then you don't want to see price be able to close back into the opening range, because that's a little bit too weak. That's a little bit too much of a pullback if it's going to be a good A. Okay, and so I find that there are times when it'll close a bar back into the opening range and then reverse and continue to go and be a good A up. But those chances, those times aren't that many. And so it's just a good rule of thumb to put your stop with a closing bar. Now, when I say a closing bar, I use a 10-minute bar chart. So that's a 10-minute bar. And so it's okay if price dips down back into the opening range, but you don't want to see the bar be able to close back into the opening range. Okay, so this is one way that I modified the ACD method, is I moved the stop to be a smaller stop. So let's move forward in Fisher's ACD method, and let's go back to where he used the bottom of the opening range as his stop. Now, he would always say that if you got stopped out at B, your bias, okay, is now neutral. With the A up, your bias was long, okay? But when you're stopped out at B, you don't go short, you just go neutral, okay? So you go neutral at B, and then you're waiting. Well, let's say price continues to be weak and move down, and it moves down to the lower stretch, okay? Or in this situation, you can only have one A. Fisher would always say you can only have one A during the day. So since we confirmed the A up, you can't have an A down. You have to have a C down, okay? And so he would call this point the C point. And this point is where you would get short, or you'd have a short bias, okay? And of course, whenever you're entering a trade, you need to know, where do you get out if you're wrong? Well, in Fisher's methodology, if you have a C down, he would have his stop at D, which would be the opposite end of the opening range. And of course, I found this way too big of a stop, to use to trade. So what did I do? Well, you guessed it. I move my stop down to a closing bar back into the opening range, and this is the D point. Okay, so the D point now is a closing bar back into the opening range, and that would stop me out, because if you've got a good C down, you want to see that thing continue to stay weak and push down. You don't want to see it to be able to move back into the opening range. And one way of looking at the opening range is, let me just say here, is that the opening range is like a value area. Okay, for those of you who trade market profile, you understand value areas. So if price gets back into that value area and it gets accepted, then it's getting back into value. It's not moving away from value. So that's another way of looking at it. Okay, so okay, let's move on to how this is, what's supposed to happen. Okay, let's say price leaves the opening range and it moves up to the upper stretch, and it confirms the A by spending 5 minutes there. And then what you want to see is, you want to see, after a bit of consolidation at the A point, you know, as the 5 minute time period's going by, then you want to see it move away from that and continue in the breakout direction to the upside. And what you might find is that during the lunch period it might go sideways for a while, but what you'd like to see is, in the afternoon after lunch period, you'd like to see it continue to push higher. And this would be, you know, if it's not a true trend day, at least it's a day that's moving to the upside of the opening range. Okay, and so this is what you want to see from a confirmed A up. All right, now if it were to move out of the opening range down to the lower stretch to the A down and confirm there, of course, again, you would like to see price continue to move in the direction of the breakout, continue to move down for the remainder of the day. So this is what you're looking for. You're looking for, once you have an A that is confirmed, you want to see it move in the direction of the breakout. Okay, now what I know is that with the ES, the ES is a reversion to mean type of market. It's an index. Okay, it's not a true trending market. A true trending market would be something like crude or gold or some other commodity that, you know, truly trends. Because this is an index, it doesn't trend that much. Maybe 18 to 20% of the time will it trend. So you want to be aware of that, and then you also want to be able to take advantage of that. And so one thing I found is that fading these A points is a great strategy, you know, to take. And as long as you know, control your risk. So what I do is, let's say price leaves the opening range and moves up to the upper stretch to the A up point. I'll get short at that number. Okay, whatever that number is, I'll put a short on. Okay, because I'm going to fade the upward move. All right, and what I'll do is I'll put a stop in, and my stop will be anywhere from 11 to 15 ticks. And you know, I say 11 to 15. That's because you want to adjust that stop to the current volatility, and you can ask yourself, what's the number of the A point? Okay, that will tell you the volatility. The bigger that A number is, like in the illustration that we used, we had a 3.65. Let's say you had a 5.65. Now that's a lot more volatility. So you'd want to bump up your stop here, maybe to the 15 tick stop. So anywhere from an 11 to 15 tick stop to, you know, try to give yourself enough room there with your stop to watch this thing as it deals with the A point. And while you're waiting out the 5 minutes, what you want to see is, you want to see it not be able to confirm the A up when you're fading it. Okay, so you want to see it come up to that A point, and you want to see it get it rejected, and you want to see it get it rejected pretty quickly. And you put your 11 to 15 tick stop in there, and what you're hoping for is, like I said, for an immediate rejection. And if you're trading multiple contracts, you want to make your first target the top of the opening range. And that's because you're above the opening range, so that's telling you to be bullish. And the first level there is the top of the opening range of support. So you even if it gets rejected at the A point, if it's going to turn itself around, chances are it's going to turn itself around at the top of the opening range. So you want to take out some profits there at the top of the opening range, and then if you're lucky and things are going your way, you want to see price be able to close the bar back into the opening range, and then you'd like to see price continue to push down into the opening range. Now, if you're really lucky and you caught a really good fade, this thing could continue to push down to the lower stretch. Now, let's think about this. Fisher says you can only have one A in a day, and also, if you didn't confirm the A up there, okay, then the A down could still be confirmed. And so prices could come down here to this A down and confirm the A down and continue to sell off. So this would be a really good fade to catch. Now, of course, not all of them are going to work out this good. That's why you want to keep a close eye on it. But let's go over, the same thing can be done on the lower stretch. All right, price leaves the opening range, it comes down to the lower stretch, and you want to place an order there to fade it. And so you fade that lower stretch, and again you're going to use 11 to 15 tick stop. And what you're looking for is an immediate rejection. You want to see price bounce back up. You're going to use the bottom of the opening range as your first target, and you're going to hope that it can get into the opening range and push to the other side of the opening range and possibly to the upper side of the opening range and on up to the upper stretch. Okay, so those are the the fade of the A. Okay, so you can either and with these fades, I would say always fade the first touch. Let's say price moved down to the lower stretch and you faded it and it bounces and it comes up to the opening range low, and you get out of the trade. Okay, you take your profits, you get out, and then price rolls back over and goes back down to the A down again. On the second time down, you don't want to be fading that, okay, because chances are if it's coming back again to the A, it could confirm it the second time. So only fade the first touch. Okay. All right. Now what I've got here is I've got a couple of real life examples here, and you can see here on this chart the two white lines, all right, are the opening range, and that marks the high and the low of that first bar, and the two dotted yellow lines are the A points, the A up and the A down, and you can see the price pushed up pretty strongly to that A up. And that A up, you can tell that if you'd have tried to fade that A up, you would have taken a loss. Okay, and if you look down near the bottom here, you'll see these purple lines. Well, those purple lines are the pivot range, and that's something for another video. I'm not going to get into that right now, but Fisher also uses the pivot range to give him a bias for the day. And so by opening so far above the pivot range, when you got up to the A up, you probably wouldn't have wanted to fade this one. Okay, but anyway, you can see that once price got above the yellow line there and spent at least 5 minutes, it confirmed the A up. There was a pullback that was right to the A up number there, and then it turned and continued to move higher. You can see that during the lunch period there, it went sideways, but it kept finding support off of that A level, and then it pushed on up higher till the end of the day. Now, I wouldn't call this a trend day, but I would say this is a good A up day. All right, now let's look at a situation where you have an A down. Here you can see that the white lines again are your opening range. The yellow lines are your A points, your A up and your A down. And we can see here that price pushed down to the A down. But if you'd have faded this one, you can see that it pushed back to the opening range low. And at that opening range low, it couldn't close back into the opening range. And it rolls over. Okay, so you can see that if you'd have taken that fade and got out of your first target, you would start to say, let me get rid of the rest of it also, because this is definitely not able to get back into the opening range. But it did offer an opportunity on first touch to fade the A down. Now, you could have also, it technically it did confirm the A down in those that second and that third bar. These are 10-minute bars, so I can tell you that that's close to being confirmed. Spending at least 5 minutes there, so you might not have wanted to faded it. But those are, like I said, it's a subjective thing as to whether the A has been confirmed or not, and you'll have to get your own timing and your own feel for it. But anyway, you can see that it confirmed the A, and it rolls over and then really gets below the A point and pushes down and becomes a trend day to the downside. And so that's how an A down is supposed to work. Now, like I said, because the ES hardly ever trends, most of the time you want to fade. Now, in this on this day here that you can see, it pushed down first, but it couldn't make it to the A down, and then it pops right back up and then moves to the upper side of the opening range, and it moves up to the A up point. Now, a couple of points here, and again, I'm not going to talk about the pivot range too much in this video, and I'll do a video on the pivot range also. But with the pivot range, it's supposed to be resistance on this day, okay? And that purple area is a resistance zone, and you've got your A point in that zone. That makes a good opportunity to fade, because you know that if it can confirm that A up and it can get above that pivot range resistance, then it's really going to go to the upside. But it also is a great place for it to fail with a small risk. And so here it would have been a great opportunity to fade that A up point there, and you can see that price was able to push back down into the opening range, then it pushed down through the opening range, and then continued to sell off for the remainder of the day. So that's a great opportunity right there to fade the A. So you really want to put this fade the A trade in your pocket. Okay. Now here's one last chart I'm going to show you. This one is this actually was a Fed announcement day, and you can see that in the morning we put in a wide opening range. I'm going to give you a little clue here. Notice how the opening range engulfs the pivot range. That almost always leads to a sideways consolidation day, whenever the opening range can engulf the pivot range. But that, again, is for another video. But anyway, price pushes up to the A up. If you would have faded that, you could have, now you can see that it didn't quite touch it. And that's going to be the case sometimes. So you might want to put a short in a couple ticks in front of, to try to catch that A point. But you'll find that these stretch points, they're spot on. And but anyway, you fade that A up, and it comes back into the opening range, goes all the way down to the A down. Again, fade that, perfect. It bounces all the way up to the high of the opening range, and then goes sideways. Then when the Fed announcement came out at 2 o'clock, you can see that it pushed down to the A down, but could not confirm, could not spend enough time there, and bounces right back up, pushes all the way up, almost all the way to the A up number there, and the day finishes going nowhere, finishes sideways. So a lot of the times you want to be thinking fade these A's, okay? And the worst case scenario is if you fade it and it doesn't take out your 11 to 15 tick stop, but it spends 5 minutes there, then you get out. Okay. All right, so that is what I've got for you today. If you want to follow me on Twitter, it's at OR4. I post the A points every day, and if you don't want to calculate them yourself, you can just follow me. I post them on Twitter, and you can mark them on your chart. Watch them for a little while and see how they work out, and see if I haven't found something. All right, guys, that's going to do it, and hopefully this video was just short enough. See you later.